Welcome to this morning's first panel. Today we're going to be talking about the cost of capital in relation to how it can influence the energy transition. This discussion is happening at a time when we're seeing yet more signs of climate change, record temperatures. We have extremely high energy prices, and this is feeding into an inflationary environment and the potential for a global recession. It's important to consider this context because lower carbon energy can be more sensitive to inflation due to the large upfront investment, plus the transition is going to cost a lot of money, so a global recession would be very unhelpful. When we talk about cost of capital today, we'll mostly be considering the electricity sector, as that's going to be the backbone of the energy transition. We'll be talking across equity and debt markets, plus hopefully also touching on private versus public markets. So if I start off by introducing my panellists, from my far left, we have Xiaoyan Zhou, who is a researcher at the Oxford Sustainable Finance Group, where she's focused on sustainable investment, transition risk, and institutional shareholder engagement. We have Tifenn Brandily, who's part of Bloomberg New Energy Finance's Energy Economics team. Bloomberg New Energy Finance is a unit within Bloomberg that provides data and research around the transition to lower carbon energy. Previously, Tifenn has worked at EDF and Schlumberger. Then we have Dominic Nash, who is the head of European Utilities Research at Barclays Bank. He's previously held positions at Macquarie, Liberium, Credit Suisse, and the UK energy regulator Ofgem. Then we have Dr. Ulf Erlandsson, the founder of the Anthropocence Fixed Income Institute, a research institute focusing on fixed income markets and the energy transition. Ulf was previously running the bond portfolio at Swedish state pension fund AP4, and prior to that he was a quantitative strategist at Barclays Capital. And then finally we have Luke Sussams, who leads ESG strategy for EMEA at the investment bank Jefferies. He advises institutional investors, private equity and corporates on ESG. Previously, Luke worked as a stockbroker, and earlier in his career, Luke was the second member of staff at the Carbon Tracker Initiative. So I wanted to start off this morning by asking you all what we are seeing in terms of divergences in the cost of capital. And this question is not just about divergences between the sources of power, between coal, oil, gas, wind, solar, but also the different sources of financing. And I thought perhaps we could start with you on that, Tifenn.
Yeah, sure. So there are different ways to slice this question, different types of funding. Let's talk about the power sector to start with. So to finance projects, you can go with balance sheet financing. And this is mostly what we see in the offshore wind sector. So we would see a company like Ørsted financing the plant, taking on some of the construction risk, and then refinancing once the project is de-risked, bringing on a more larger investor like GIG or Macquarie, and allow the project to lower the cost of capital to live its life until the decommissioning 25 years later. So this is balance sheet funding, and balance sheet funding is also a key way that oil and gas companies use to finance their activities. On the other side, you have project finance, and project finance is typically linked with the infrastructure investment practice. And you'll see mostly solar and onshore wind being financed under a project finance framework. And so why do these companies use project finance? Well, once you have a setup entity that is legally bound and has its own risk, you can easily pass it on to an institutional investor. So you'd have project developer building the plants and selling it onto an insurance company or a pension fund, for example. And the refinancing happens at a lower cost. So it's all about adjusting the financing to the risk profile of the project. when the project is under construction, there's still a high cost that the developer takes on. When you go into commissioning, the project is de-risked, and so you can reduce the cost of capital. This is one way to see it, balance sheet finance versus project finance. On the other side, you can also slice this question by regions. And typically we've seen regions like Japan or Europe have very low cost of finance. This is mainly due to central banks' policies, quantitative easing in Europe. We're seeing higher cost of finance in North America, higher cost of finance incrementally also across APAC. In the renewable space, project financing is mostly happening in local currency. This is a very important detail because the local currency determines also through inflation how high the cost of capital will be. And so this is important to take this into account. The only caveat here is in Latin America, you're seeing a lot of USD financing coming from the States. And so here you'll have to have some type of de-risking approach, just making sure that the currency risk is taken into account. So maybe I'll leave it there for now.
Maybe, Xiaoyan, you could talk a little bit about the research that you have done into the divergences.
Yeah, yeah, sure. So I have been working on a research project of the energy transition and cost of capital. So in this project, we track the changes in the cost of capital across asset class, across regions, and over the past 20 years. So we first look at the cost of capital, cost of debt in the loan markets. Since we're focusing on electricity specifically, so in the power generation, the loan spreads for the coal power have been increased by 38% over the past 10 years. But however, the gas power, we see the loan spread only increased marginally around 7% over the past 10 years. But we also observe that there's a large decrease in the renewables. The largest drop occurred in the wind power, with 31% in the offshore wind, 16% in onshore wind, and 16% in the solar PV. We're also looking at the changes in the cost of equity over the past 20 years. The major changes usually occurred around the 2008 financial crisis and around 2015, the Paris Agreement. So we have noticed that there's a large increase in the cost of equity in fossil fuel electric utilities, especially after the Paris Agreement, has increased by like 1% from 16% to 17%. But we also observe there's a decrease as well for the renewable electric utilities, down by 1%. But both cost of debt, cost of equity, we have seen there's a large variation across regions, especially in the emerging market, they experienced much higher financing cost compared with the developed markets. And as IEA last year published a report on cost of capital in the clean energy as well. They also found that the cost of capital could up to 7 times higher in the emerging market, comparing the Europe and the US. That's our observations.
Thank you. Did anyone else want to jump in on that?
I mean, I kind of have a view, I guess, is that up until sort of the last sort of 24 months, I guess it's been quite a clear trajectory that sort of fossil fuel projects are becoming costlier, let's say, in terms of the cost of capital, and renewables are becoming cheaper. I think the events of the last sort of 18 months or so have kind of flipped the world on its head a little bit. You know, oil is the best performing sector, you know, essentially on a year-to-date basis. Demand after COVID rebounded more strongly than people expected. disruptions due to the conflict in the Ukraine means the price has gone exceptionally high. Whereas if you look at some of the low carbon technologies and sectors, in particular the wind sector, I mean, Dominic will know this a lot better than I, but you know, the wind sector is hit with a perfect storm of headwinds pretty much at the moment. You know, higher commodity input costs, higher interest rates, slow permitting. I've got one other, overseas competition from the Chinese coming into Europe, companies like Mingyang. And from the investors that I speak to, of course, that's being translated, therefore, into a greater perception of risk to the sector, which will then translate into a higher cost of capital if it isn't already today. So I thought the direction of travel was quite clear on this, but the events of the last 18 months have kind of flipped the world on its head. But I don't know if you'd agree with me, Dominic, on the cost of capital with regards to the wind sector, but you're not supposed to touch that. Can't touch the red button. Can't press the red button.
Okay, yeah, thank you for that. I think I'd probably just take this up to sort of 30,000 foot quickly, if that's all right, and just give you my take. I advise and have invested directly in these projects and companies that do the projects. Investors are simple creatures, number one. Don't ever think that that they've got this some sort of magic complex algorithm that sort of churns out three significant figures cost of capital. They're very simple creatures. And the first thing that you look at, number one rule in investing, is basically what's the risk and what's that return that I'm going to need to invest in it. And a point I'll sort of bring out here first of all is that there's a difference between theoretical cost of capital and perceived or sort of measured cost of capital, which I think a lot of investors don't necessarily get confused with, but it does give you the wrong signals. So the theoretical cost of capital is what everyone always starts with, and that is driven by everything that was being said earlier. But the number one question that we look at is what's the strength of the contract you've got, what's the volatility of the revenues, what's the volatility of the profits, and that's the best risk measure. And if you've got a long-term CFD or a PPA with a renewable project for the life of a renewable project, essentially you can put an extremely low cost of capital on this. And when I talk cost of capital as an equity investor, which I am, and I know Ulf is more of a credit, so I'm sure we'll coming off this, we always start with unlevered. You always start with unlevered returns. And then the second thing that you would then lay across that, of course, is what else can I invest in elsewhere? And that with the same risk. And that's the reason why, as you all know, I'm sure you all know, the basis of the CAPM model and risk-free and what goes on in different countries with different currencies, different inflation rates, have an impact on the cost of capital of something that you think probably it shouldn't have, but it does. And then finally what you then do is that these will throw up some odd numbers in it. You then put a bit of sort of scratch your head and go, would I put my own money in for that return? So the numbers might come up with, I don't know, make these numbers up, cost of equity, say, I don't know, 5%. And I'll look at that and go, I wouldn't put my money in the 5%. So you come up with like a second layer or a third layer of basically just making it an art rather than a science. And if you look at what Ofgem is doing, for example, on cost of capital for the regulated networks, that's precisely the process they do. They'll have a fundamental analysis. You'll work out that gives you a range between 0 and infinity. And then you basically sort of narrow it down to a number that you think is going to be acceptable based on conversations. I will say, though, one thing interestingly, when we talk about what it looks like, the cost of capital, and again, when you mentioned about your cost of coal, there's often a confusion between cost of capital and cash flow risk. And I think that this is something that a lot of investors then put together into well, if I invest in a coal project, I need a much higher cost of capital than if I invest in a merchant biomass renewable power station. But actually the risks of those two are identical. And if you put the base cases, even if they're not identical, let's assume that they are. I know some people will probably grab me after this and go, you know, biomass has this risk and coal has that risk. But if you assume that they were the same risk, you'd have the same cost of capital, but you would know that if they were trading on the equity markets, when you looked at the cost of capital, the coal would perceive to have a much higher cost of capital. And that's a cash flow risk. We use a baseline cash flow number. But if you then kind of go, look, there's a 20% scenario where this coal gets closed early, that cash will not materialise. That will come out as an implied higher cost of capital. So you've got to be slightly careful when you compare your questions as to what is your cost of capital and what is the cash flow risk that then drives what looks like a cost of capital number.
And I'll chime in directly on that because, as a fixed income person, it's very much a closer link between cost of capital and the fact of cost of debt, because you're raising new debt the whole time. You're starting to pay the coupons that sort of accrue at the new cost of capital. As we're seeing right now, interest rates are rising. That's starting to sort of really show up as cash flow items for debt issuers. And that is different relative to what you see in equities, where the implied cost of capital is, well, dividends are discretionary in some sense. You can sort of play around with that number. It doesn't really kill a company if cost of capital starts looking really high on the equity side, because you don't have to pay it out in that way. And this is really interesting because we're at the new juncture in the markets right now where even around this time last year, we put out a research note, not a trade recommendation, on one of the big oil companies where dividend yields look extremely high. Equity prices were depressed relative to dividends, and the debt side looked extremely tight, extremely cheap in terms of raising debt. So for a company like that, it makes a lot of sense to raise more debt and just pay it out to shareholders. And that looked like a interesting proposition. This is a company that the hedge fund engine number one engaged with, and they actually bought equity in order to sort of engage with the board and start pushing new policies across that. And I think that's quite interesting from a sort of a sustainability investing perspective, that you can look at this different part of the capital structure, and you can be engaging on the equity side, you can be shorting on the debt side, and you can get some sort of interesting transformational pressures within companies on that one. Flip to today, where the relative multiples between cost of equity and cost of debt has shifted completely. So we're in a quite different situation, and that has happened just over the past 12 months. I think that's going to be, if we're going to look at future trends, that's going to have a lot of sort of shakeouts, also going into private markets where you're really playing the cost of equity versus cost of debt in a structured format. And we have a lot of those facilities that went in with the assumptions of what happened, where we were last year, and now we're at quite the different place. So that's going to be an interesting situation here, and then how that translates into different investment strategies relative to fossils versus renewables, etc.
Tifenn, did you want to jump in?
Yeah, just to add in something about coal-fired power plants, because we talked about it. So most coal-fired power plants are financed in India, Southeast Asia, and China. And our analysis at BNEF shows that the cost of capital for those projects, 30 gigawatts of new capacity in China every year, they haven't changed. They are still financed with state-backed utilities. And so this is one of the key challenges we have ahead of us when we think about the next 28 years. And Sarah, at the beginning you mentioned the dire situation we are faced with. So at the current pace of emissions, we have only 8 years before we exhaust the 1.5 degrees carbon budget. And so when you think about that and some of the momentum there still is in the coal power sector, I think capital costs have a role to play, but policy can have an even higher impact on deployment. And so we will need to see both phase out policies in OECD, but also slowing down the rate of additions, but not just playing on the cost of capital, but playing on the investment decision itself.
Just while we're on coal, obviously at the moment what we're seeing, we'll have questions at the end, I promise. At the moment what we're seeing is restarting of a lot of coal assets, the extension of coal, gas, nuclear assets, lifespans. Is cost of capital a factor in those decisions, or is it absolutely irrelevant? It's, no one's worried about what this costs financially.
Can I just jump in here?
Yes.
I'll speak from a European perspective, and I'm sure we can talk about other markets where it's different. We're obviously in a bit of an energy crisis.
Absolutely.
I think this is probably a question maybe later on about the role of ESG, and I think we mentioned it, but I think it's going to go through a reinvention, focusing probably more on the S going forward, and then what is the sustainable transition rather than go all in at a risk of relying on an unreliable trading partner. But basically, in Europe last year, I think about 160 BCM of gas was burnt in gas-fired power stations, and that's, I think, in a total of 570 BCM in Greater Europe. So the issue is that, and I think Nord Stream 1 today has reopened, but it's opening at a low capacity, so I think we're going to have shortages of gas this winter. And there is only a small, limited number of things you can do. And our view is, and the research we write is very clear, there's nothing Europe really can do for 5 years. There's going to be a 5-year problem, high energy prices for 5 years. And what that's going to involve is try and get more LNG in. Well, Central Europe doesn't have any LNG facilities, so that's limited. You then basically go, well, you can bring LNG into the peripheral markets. UK, Spain, Italy has LNG, but there's limited interconnections. And it's interesting that the UK is now exporting like there's no tomorrow, both power and gas to power and power. And then you look at renewables and go, well, we can up renewables, but how long does it take to build a scalable renewables? Offshore wind, 5-8 years, nuclear, 8-10 years. I mean, you've got to put these in, but these are not short-term solutions. So really, the only easy solution on this is to say, well, look, you've got nearly, a quarter of all gas is burnt in gas-fired power stations. We've got a lot of spare coal-fired power stations knocking around on quite low utilisations. There isn't a great deal of spare coal globally, but there's some. That's the only solution you've got short term. So, for what it's worth, they're going to print money. I mean, the power prices are ridiculous. I mean, French baseload next year, last time I looked, was 460 euros a megawatt hour baseload, and it should be about 40. So the UK was at £300. I mean, we're going to have, on my numbers, half of all Europe's going to be in fuel poverty next year. So the coal-fired power stations, if they were to secure coal, it's not a cost of capital issue. It's just how much money can you actually print. Interestingly, the UK coal-fired power stations, which are fired up, have been all put on quite low contracts. So they're not going to be price gouging or making serious profits. That'll basically be subsidising the consumer, but I think in other markets. But that's the European perspective, and over to what's going on.
Xiaoyan?
Yeah, in terms of the coal mining or coal power, I would just say a bit of our observation for the past 2 years. Sorry, we're just looking at the cost of loan spread in the loan market for the coal power and coal mining in China and India in the emerging market. So over the past 2 years, even though the loan spread for the coal power still remain quite high comparing other energy type, but we say it's been decreasing largely by 30% in China. I think that's something, but this changes we didn't observe it in Europe or in America. I guess the policies or the carbon pricing and maybe local financial systems has played a role in determining the cost, the loan spread, the cost of debt. Because the loan, in theory, cost of capital is supposed to embedded or measured all the risks associated in the project has been translated or reflected in the cost of capital. So that's something that's worth to notice. That probably will be more work to do for the policymakers or institutional investors. Thanks.
I think we spoke a little bit about risk. There's a concerning factor that's happening in Europe right now with regards to governments bailing out failing sort of fossil-based companies. So they're essentially signaling that whenever it's a power issue, we're going to nationalize like EDF, like Fortum, Uniper, and just in order to get the business going. And that also says, on the equity side, the cost of capital, well, for a government entity, that cost of capital is not really relevant when it comes to the equity side because they can burn tax money. The debt side gets more interesting, but that's also, as you were saying, printing money. Of course, there's going to be some strong arming into having other facilities buying the debt of these sort of semi-failed utility companies to keep their cost of capital low, because otherwise it's going to be taxpayers having to pay for it. So I do think it sets sort of a bad precedent internationally when Europe goes ahead and sort of constructs these things where governments are always supporting the companies without, taking loss shares from other investors, really.
Tifenn, did you want to jump in just on that point of these nationalisations that we're seeing, whether we might see more of it, and the role that cost of capital is playing in that?
Yeah, sure. Let's take the example of EDF, for example. So you have the largest utility in France and one of the largest utility in the UK, financing 2 large nuclear power stations at the same time. One that started construction in France in 2012, and one that has started, Hinkley Point, started construction much more recently. Between 2014 and today, the credit rating, the S&P credit rating of EDF has gone from A+ to BBB. And so there's been, I think, 5 or 6 downgrade events since then. And so this speaks to the difficulty of delivering nuclear project, number one, but also this also interrogates us, as financing community, the extended financing community, about some of these large utilities and their role in financing the energy transition. So in 2021, a bit less than 1% of GDP has been invested in low carbon activities, renewables, electrified transport, hydrogen, CCS, energy storage. In order to be on track with the net zero trajectory, Paris aligned, we would need to have 3% of GDP. And so that raises the question of, what's the role of these large utilities? What type of cost of capital are they going to have over the next 28 years, knowing that the transition is coming? We're going to see less oil demand over time as the transport electrifies. I'm talking about 5 to 15 years horizon here, but there's going to be a need for a large amount of debt to deploy these capital-intensive infrastructures. And I think the nationalization of EDF, this is still happening. So I want to be careful here, but this is an event that shows, what could happen in the transition. The transition is both about carbon, but it's also about which type of companies are going to be the leaders over the next 28 years.
Dominic, did you want to jump in on that, just given you know all these companies very well, the utilities?
Yeah, I mean, so the EDF, whether it's nationalised or it has always been mostly nationalised, but whether it's been nationalised or whether it's private companies, the most important thing is how it's regulated and for what the incentives are there for the company to do what is meant to do. On EDF, and indeed when I was talking about the other Europeans, like particularly in Uniper, which I think it's probably has got one or two problems. The key issue here, and I think the main reason why EDF has kind of gone so quickly, is that when I ran my numbers, I think the average French consumer should be paying about €5,000 a year for power next year, and we're going to have some problems in Germany and elsewhere, and I think that you're kind of hiding it. So basically, one of the pushbacks you're going to get here is whether you're going to end up with you will end up with government intervention, whether there's going to be a windfall tax, or whether there's a reform of the power market, which is what I think will happen, for what it's worth, or whether it's going to be nationalisation. It's all part of the same issue, which is you have got a 5-year problem. And the politicians that I speak to are only just really firefighting at the moment, but the medium-term impact of total reform of the power market has to happen. The renewable cost of capital question is quite an interesting one, because currently you might have a 15-year fixed price contract with a 30-year life asset. You will not get what the assumptions are for year 16 to year 30 out of any company. And one thing I'm certain is that everyone's wrong. But what you kind of are hoping for probably is that a marginal cost power market doesn't work when you go renewables, because you'll have zero. I mean, I've been writing for a long time that power's going to go to zero, and at the same time, it's not working the other way today with gas. So we will get a reform. For what it's worth, I think if you get the right reform, you'll get the cost of capital coming down.
I mean, obviously the question is, what's the right reform? You cannot answer that, that's fine. Did anyone else want to jump in on that, or I will keep moving? I was actually going to go back to Tifenn just on the levelised cost of electricity. I wondered how important the cost of capital was as a component for different sources of energy. So is there much greater sensitivity, for instance, between solar and natural gas?
Yes, absolutely. So if you look at the levelized cost of electricity for solar and wind, you find that approximately 70% of project cost over the entire lifetime are capital costs. So it's both the combination of the cost of building the plant, so the capex, and the cost of finance, equity, interest rates, so interest payments. On the coal and gas side, you find the exact opposite capital structure, or cost structure rather. You have 70% of the costs that are variable, coming from fuel, carbon in Europe and in China now, and the rest is capital cost, so 30% capital cost and O&M. So you have kind of flipped cost structures, and what this means in terms of kind of the leverage that cost of capital has on the cost of electricity. For every rise, 1 percentage point rise in the cost of capitals for solar and wind, you find on average a $1 to $2 per megawatt hour. So that's a rise in the LCOE. That's equivalent to 3 to 5% increase relative. For offshore wind, it's a bit higher, more capital intensive. But for fossil fuels, cost of capital do not have the same impact. What has an impact is what my peer mentioned, which is the volatility in input prices, the volatility in fuel prices. What's the run rate of the power plant? Does it get to run at a high capacity factor, or does it only run during peak power prices? And maybe to rebound on what my colleague said, I think when we think about power market design, there's a very important flaw in the current design we need to address, which is the fact that an imbalance in the gas price, imbalance in the gas market, is contaminating the pricing of every single asset in the wholesale power market. And so you could have, for example, a fully amortized hydro asset, which is capturing $250, $300 per megawatt hour of margin. So that's the current situation. And so the adequate answer, in my opinion, is to go towards more long-term pricing. And so we've seen the CFD auction in the UK a few weeks ago with a landed price of around, below £40 per megawatt hour for offshore wind. And so that raises the question, to me, whether we should reorient some of the funding more towards long-term contract, as opposed to paying each amortized asset on a marginal cost basis.
Did anyone else want to jump in on that? It's okay if not. Ulf, I wanted to ask you about a development in debt markets, which has been these sustainability-linked bonds that we've seen. Earlier this year, Chile launched one. It's bonds where there are targets attached to them, and your repayments will vary according to whether you're meeting your targets. For Chile, I think that they set a target for 60% renewable energy by 2032. They had a couple of other targets involved, and I think they're not alone in launching these type of bonds, but they're relatively new. How do they compare to green bonds? Is there a difference in the cost of capital between those two different types of bonds? And is this kind of a sign of maturation in sustainable financing?
Yeah, so sustainability-linked bonds are, I think, a very exciting new development in terms of sustainable finance. I'd rather almost see it as green bonds version 2.0. The main difference between a green bond and an SLB is that a green bond is trying to sort of soft ring-fence certain assets. So you raise $500 million, you put that into some of your solar PV or whatever projects you have. It's not legally ring-fenced, but it is sort of a commitment from the issuer. So that makes it like non-full balance sheet funding, whereas the SLB puts a focus on the issuer's full sort of footprint. So for example, we're looking at the situation right now where EMEA, the Italian oil company, they're looking to come to debt markets. They issued an SLB last year. And what they will have within the SLB structure are certain targets, like we are going to reduce carbon intensity or carbon emissions by XYZ by this year. And if we're not able to do that, then we are going to pay a higher coupon on the bond. Now, this gives a very holistic view of the company, which I think is a good thing, because what you've had before in the green bond market is that you could theoretically run a coal operation on the one side, and then you have some green assets, and you could raise green finance for those assets, whereas the SLB structure looks at the whole company. It's also interesting because it does something slightly different, and we've been writing around this in terms of almost looking at as these sustainability targets as like a financial option. So if you look at it from the investor perspective, when you're buying an SLB, you're buying a straight bond plus an option on a higher interest rate in the future at some point, if they don't deliver on the targets. And that you can start pricing, and that also gives you some way to argue that, using ambitious and pretty, bigger SLB structures than you have today, you could actually get a substantially lower cost of capital. We've been playing around this with some cases in South Asia, where you can argue that if you have a single coal plant standing around somewhere, someone tries to refinance that in order to actually build renewables instead, they won't be able to access capital markets right now, because if you only run a coal-fired power plant, it's very hard to get funding. And that's a problem, right? Because if there's something we really need is these sort of coal shutdowns, coal transitions into renewables. The SLB structure is perfect for that. You can sort of say, okay, we would provide you finance at 8% if you were only coal, but however, we are going to provide you with finance at 6% if you promise to shut down the coal and go fully renewable within 5 years. If you don't do that, then we're going to hike the coupon and get 10%. And that gives a very that's a good deal for the issuer of the bond. It's a good deal for the investor that wants to drive transition. And I think this can happen in a lot of the hard-to-abate sectors. And that's, I'll prop the report we wrote, but on this upcoming EMEA issuance, it's the first SLB out of the oil sector, or the one they issued last year. They have sort of ambitious net zero targets, including scope 3. And if you sort of cram that into an SLB structure, that would be quite exciting, I think.
Do you think, obviously Chile was a sovereign bond, do you think it'll be used more by countries than by companies, or do you think it'll be oil sector specific potentially going forward because they're the companies that need to transform themselves?
I think it's more powerful in the corporate sector, to be honest, because it's easier to design these targets and the key performance indicators. It's harder on the whole national level, and there's much more sort of fidgeting with the accounting you can do. An interesting part of this is that it also gives the investor an incentive in the SLB structure, because you're going to get paid more interest if the issuer is actually not reaching their target. So the investor should be really interested in that this gets measured properly. And that's also a difference with the green bonds, where if you've invested in a green bond, you hope that they actually do what you want. You don't have an incentive to really investigate what goes on with the money. In the SLB, you have quite the opposite. You have like a financial incentive to go and look for that, which is good for data provisioning and all of these other things that we generally talk about in ESG.
And just while we're on bonds, we saw the European Central Bank say it plans to incorporate climate considerations into its corporate bond holdings recently. Do you think we'll see more actions like this, and do you think it'll have much of an impact on the cost of capital?
Well, I shall be kind when I discuss this, but I think it's quite fitting that the ECB finally commits to do something about their corporate bond purchases as they announce that they're not going to buy any more corporate bonds. That's sort of the timing, right? But hey, I think it's a really important issue. We did some analysis on the ECB's balance sheet of the bonds they bought. The carbon footprint of the top 25 names that they hold is something like 3.5 to 4 gigatons, which is roughly 10 to 15% of global annual emissions. This is an investor that does not engage at all with issuers. The bonds they hold on average 30%, so they are like the big dog out there. And we had the gentleman from the Bundesbank yesterday discussing this, but I think it is fair as European Union citizens to ask, so the ECB, you bought 300 million of Glencore bonds. How does that help me as a European Union citizen? Why are you buying BP bonds? Why are you buying other UK companies like Royal Dutch Shell? Why are you buying those fossil companies? And it's not only buying, you're actually literally lending money to this. You're lowering the cost of capital. It makes it possible for companies like Total to go off to East Africa and build oil pipelines. You actually see some of the European fossil companies being able to go and do capital intensive projects where no one else is willing to do it. And that's on the back of having a very willing buyer of corporate bonds in Europe. And that's a big issue. It's very positive that they're changing this around. But it's sort of too late. They started talking about this 2 years ago. That would have been the point of action rather than now when they're not going to buy anymore.
Luke, I wanted to come back to you on a point that you made in your opening remarks about how much things have changed in the last 12 months. And I wanted to ask you how investors' attitudes towards ESG are changing and whether they have different expectations on returns than they do perhaps in other asset classes.
Yeah, I mean, I think Dominic said it right, that we're in quite an interesting point, I guess, within ESG, and some of the media coverage of it sort of frames it as a day of reckoning, and I think that's probably true. Off the top of my head, I can think of immeasurable, numerous criticisms that are being aimed at ESG at the moment. Greenwashing, not delivering real economy impacts, contributing to high prices in oil and metals and mining, and so on and so on. So ESG is sort of, in this sort of inflection point, I would say. But in terms of returns, ESG investors or ESG-focused investors really aren't really willing to compromise on returns for ESG profiles or greenness or sort of ESG credentials. I think we see it a little bit in the bond markets, of course, where investors sometimes are willing to accept a higher price and a lower yield for greenness. But in the equities market, not really. And the way that you can kind of think about that is that ESG-focused investors sort of sit along a spectrum, really, from those that are almost skeptics and at very best sort of using negative exclusion screens, and that's as far as they will go, to sort of in the middle, relatively adequate ESG integration and sort of a consideration on the risk-reward profiles of stocks. And then on the sort of furthest end, really sort of a very impact-oriented approach to it. And maybe perhaps on that impact end of the spectrum, some investors are willing to, potentially compromise returns. But even then, when I've said that to sort of impact investors, some sort of bulk and quite aggressively. So no, I don't think that investors are really willing to compromise returns, particularly at the moment. ESG products, portfolios are underperforming the market because of sector weightings and not having exposure to sectors like oil and gas and aerospace and defense. And so pressure now on ESG-focused investors from a fiduciary duty perspective in terms of returns is probably greater than it's ever been before.
Dominic, did you want to chip in on this? Just to put you on the spot.
I don't disagree with anything you say at all. I mean, a couple of points I'll add is that when we talk about investors, we're talking about intermediary here. So we're talking about fund managers and people that you and I probably have as our clients. They have their own pressures. The finance industry, for what it's worth, is under a lot of pressure at the moment with the Spritzer rules and the MiFID II regulations. The amount of commission that you can charge your people with the money has fallen. So basically the finance industry is always trying to look for a way of creating new products that have appeal. ESG has been a very, very successful product for the last 3, 4, 5 years. And the inflows have been staggering. And in 2020 in particular, I think the inflows were off the chart, but almost, when you looked at the investable universe of the ESG stocks in 2020, it was very small. And so the more inflow you had, the higher the stocks went up, and the more that stocks went up, the better performance of the ESG. The better performance of the ESG, the more money came in. And so you had this beautiful virtuous cycle. And what happened is in 2021, I mean, I remember I'm afraid I was quite negative on the valuations of all renewable stocks at the start of 2021. They were bonkers expensive, and they have been very poor performance since. And fund managers have league tables and KPIs and careers, and so that's the reason. That's another pressure you have always got to be aware of here, I think, on this one.
You know, I might almost just want to add some colour to that, because I recently was looking at the financials of Vestas, and it really is quite staggering. You know, if you look at its sort of EBIT margin, the consensus view for this year is that it's going to be minus 3.8%, I think. And in 2016, it was sort of closer to 16%, I think, which shows that for industries that have very strong growth trajectories, it doesn't necessarily mean that the company makes money and is profitable. And that's what ESG in particular is sort of having to deal with and consider when it comes to looking at equities from more of a perspective than just how green they are.
Yeah, I think the wind supply chain might be an interesting place to look at on that question of more nationalisations in future, depending on how European governments are looking at it. I also wanted to, well, with you, Luke, ask about private markets. I mean, you advise private equity. What are you seeing there? Is it exactly the same reflection on divergences that we're seeing in public markets? Is it any different?
Yeah, I would say, I mean, broadly it's very similar. Perhaps I would say that there is a broader range of objectives and priorities when it comes to PE firms and what they're looking to invest in. And that fundamentally, therefore, feeds into their required rate of return. For example, you know, there are, of course, at one end of the spectrum, PE firms that are looking to invest in private oil and gas companies that will pump every last drop as quickly as possible at the lowest standards possible, you know. I think BP is selling its Alaskan assets to Hillcorp Energy is sort of one example where it was sort of found that after Hillcorp took it over, fugitive emissions and emissions from the project in general went up quite dramatically. And you know, similarly with regards to North Sea oil and gas production, it's increasingly moving into private hands. So I think it was Rystad Energy said that in 2010 it was around 10%, and now it's over 30% in terms of production that's in private hands. So there is that side of it, but then as sort of Bob Eccles sort of said yesterday, at the sort of impact and highly ambitious side, PE firms are probably best placed to deliver that sort of impact. And there are no shortage of examples of PE firms looking to transform companies and deliver real economy impacts. You know, there's sort of the TPG Rise Fund, there's Engine Number One that has a product called Climate Transform, which essentially only invests in dirty companies and is just going to give them hell. And then there's a Nordic company called Summa Equity that just raised the largest European impact fund. And the really interesting thing about all of these sorts of firms is that they go to extreme lengths to quantify this impact. They're using all of these methodologies that are so sort of quite academic, to be honest, like the Harvard Business School's impact-weighted accounting, trying to quantify and measure the real economy impacts of these companies, which is, you know, investors in the public markets, you know, invested in listed equities could never do that because the data just doesn't exist. In private equity, that, you know, the investor just says, you will get me that data because I own you. And so, yeah, I would say it's probably slightly more polarized, let's say.
Just wanted to ask a question on regulation. I might start with you, Xiaoyan. Just the role that regulation is playing in the divergences that your research showed in the cost of capital. Is it everyone anticipating regulation, or is it actually some of the regulation starting to have an impact?
Yeah, like in academic various research has provided evidence showing that regulations such as tax carbon pricing definitely could translate into cost of capital, either in debt loan market, bond market, or the equity market. We also, in our studies, we also found that like not only the penalty regulation, but the supporting policies such as feed-in tariff, and maybe some initiatives such as trading, carbon emission trading schemes also could actually reduce the cost of capital in the clean, in the clean energy as well. I do think the policy play a major role in affecting the cost of capital.
Maybe if I could, just because both the EU's taxonomy and the UK's taxonomy, when it comes, are both designed to lower the cost of capital for green activities and therefore greener companies. But I guess I have sort of a theory on this one, but I don't know if it will materialize. But you know, obviously the markets work on what is mispriced or misunderstood. And so the taxonomy, through enforcing or requiring companies to disclose their green revenues and their green capex, will try to lower the cost of capital. But the way I see it is that most of the companies that will perform very highly on that metric, we already know they're a green company. You know, public companies, if they have even a shred of a green story to tell, they will tell anyone that will listen, and they will stand on the nearest mountaintop and shout it. So I'm not sure that we need the taxonomy to understand that Vestas has 100% green revenues. You know, we know that, it's priced in. So I actually don't think that that regulation will necessarily lower the cost of capital for green equities. What I think could happen is that it will expose companies that have been making claims that they are greener than they actually are. So it could increase the cost of capital for browner, you know, equities and economic activities. But in terms of lowering the cost of capital for green companies, I think we already know it and it's priced in, personally.
I think also, if you want to leg into this, what is actually required for this climate transition, right? The issue we haven't had really has not been the cost of capital on the green side, but the low cost of capital on the fossil side. So the sort of the way we allow the financing of the incumbent technologies out there. If you have a massive balance sheet of lots of oil rigs and pipelines, it has cost you nothing to refinance that balance sheet. And often supported by, again, if we're going to go back to, you know, something like corporate bond purchase programs, they are buying the debt of incumbent actors. Those are already in market, which is, you know, the old economy, and that is sort of problematic, and that's where regulation needs to think about seriously, not only trying to depress the cost of capital for the green, but also, you know, shift the relative cost of capital significantly. And it might be more efficient to actually drive up cost of capital on the fossil side. Might be more efficient to do it that way rather than just looking for everyone to run in the corner and buy, you know, overbuy the renewables or go full ESG.
To say that, I mean, following from that point, I'd say there has been a capital strike on fossil fuel companies for a number of years. The big oils, actually, up to only about 12 months ago, didn't have much cash anyway. Oil prices were really very low. They didn't have much spare cash to reinvest in fossils. All the companies I cover, the utilities, European utilities, I can count on the fingers of one hand the amount of thermal-fired power stations that they're building in Europe. They've been upping investment materially, and it's all in regulated networks and in renewable energy. The banks out there, if you go through their public statements, are basically saying they're winding down their the carbon content of their debt books. So I would argue that we have had increasing cost of capital for fossils. And when I speak to CEOs of some oil companies of the sort of the pure E&P names, and you ask them what their cost of capital is, they're quoting numbers like 15% or so, which is absurd.
Has that come disproportionately from the equity side rather than the debt side?
Well, a lot of the E names won't have that much debt against them. The vertically integrated, oil majors, of course, right, will be where the debt sits. But it doesn't matter if you're a merchant thermal-fired power station or an oil well, your risk is high, and that's price risk. And so you will predominantly be equity financed. And if your cost of equity goes up, your hurdle rate goes down. And then coming back to my cash flow risk I said earlier in this panel, there is a real risk as what life do you put this asset on? So you're shortening it and shortening it. The numbers don't add up. And that's one of the points that I'm trying to say here about the whole sustainability issue, which is you've got to be careful for what you ask for, because if you have a capital strike and you end up with shortages of fossil fuels, which we are currently seeing, we were talking $100 oil even before Russia invaded Ukraine. The people who get impacted most will be the poorest of society. This is a regressive taxation. You will get, and I've seen this, I've been in the industry for 30 years, I have seen two previous big enthusiasms for energy transition, and they both ended because the general person on the street basically said, I'm not prepared to pay for it. And there's a real risk that if you get that we're going to be in that position again. So to counter your point, I'm all for energy transition. I feel like I'm speaking to the wrong audience here, but I'm all for it. I'm just basically saying that there are more things you've got to be conscious of, because the law of unintended consequences is alive and well in this industry. And personally, I think that you need to probably keep energy as cheap as possible and then use regulations in other ways to either get the cost of capital down for renewables and or choke off fossil, things like carbon taxations, or literally just putting in different policies in place.
I think Dominic's sort of hinting towards probably what is the elephant in the room, which is that this discussion on cost of capital and it being an effective mechanism for altering the supply side is obviously really important, but climate is kind of a demand side problem. And in virtually all of these discussions, there's very little discussion around how to solve the demand side, either reduce it through behavior change or regulation and so on. And it's probably the gaping hole in the UK's net zero strategy, and it is virtually in all of these conversations. But
I'll disagree a bit on that point. I think behavior has a role to play, but solar and wind already generate 13% of global power generation. So the alternative technology is there in the power sector, which is the #1 sector in terms of emissions. In the transport sector, we've seen last year, 2021, global car sales. We've seen a very interesting trend in the global car sales. So electric vehicles now represent 10% of global car sales. It's mainly happening in Europe, mainly happening in China. But some of the auto manufacturers, the incumbents, have 20% electric vehicles in their car sales already. So some of them are leaders in this space. And I think we will need regulation, to answer your question, Sarah, to make sure the alternatives are here on the supply side. It's not just about demand, it's about supply as well. We need supply side policies. We need long-term contracts, because the market itself is not going to deliver a net zero transition. We need a transition which is infrastructure heavy. Hence why I'm always beating the drum of long-term contracts that will need to be provided. It doesn't need to be just a tariff. It can be competitive, and competition has been instrumental in reducing the cost of capital, as we discussed, but also scaling up both the manufacturing side, making sure asset managers have larger portfolios. With larger portfolios, you are able to negotiate better investment, better equipment contracts, better O&M contracts. And so we need to play on all the levers to make sure we can deliver on the transition.
On that note, can we open the floor to some questions? We've definitely got some. Jim's got a roving microphone. Jim, if you could start with this gentleman here. If everyone could introduce themselves by name and organisation, that would be great. Thank you.
Is this on? Yeah, thanks. So, Mike Clark, our advisory. Just picking up Luke's last point, and challenging Tiffen's markets won't deliver it. I'm going to suggest the panel have been delivering comments with an underlying assumption of an orderly transition. And if we sort of say things like hope is not a strategy, and challenging Tiffen's point, the markets may deliver the transition because Mr. Minsky may arrive. So if the panel will humour me, 6 weeks ago we all started realising the market tipping point had arrived. We'd realised we'd been mispricing this thing significantly. There's beginning to realising that actually we have reached the tipping point in capital markets because we've not been doing enough. So would the panel begin to paint a picture as the rubble continues to fall? We still don't know quite what's going to happen, but we just know we've been pricing this stuff wrongly. So paint a picture that if Minsky does arrive, what does the cost of capital begin to look like, please?
Well, and I think this was something that I had in my list of questions, but I realised we were running out of time, so I'm glad you asked. The extension of that question would also be, if this isn't orderly, if we have sort of a situation where governments have to take very drastic action, does the cost of capital as a worry, a concern, a reason to take action or not, go out the window? Is it even a consideration at that point?
Well, yes. Yeah. Okay, I'll pitch it in two ways. Is that you've got competing sources of capital and you've got competing demands. And correct me if I've interpreted your question wrong, but you're basically saying if we go to sort of full-on climate emergency, what levers get pulled and what happens to the investment. First of all, you're going to have to see significant increases in regulation and in the demand profile for getting the mechanisms in place to get the incentives to get the stuff built. Okay. Coming back to the earlier point, though, is that investors don't have to invest in this area. They can quite easily invest in bonds or properties in across the whole market. So you're never going to get a free lunch out of them. They'll go, if I can make 10% investing in Google, or I can make 4% investing in renewable energy, I'd rather be in Google, thank you very much. So you do have to have a competitive market-led cost of capital, and it'll be up to the governments to, if they want the private sector to be involved in this angle on it, will be up to the private sector to put the mechanism in place that gets you to that tipping point where the cost of capital is equivalent to everything else. It's all doable. The second impact would be, though, is that if you look at your numbers, I mean, for what it's worth, I think we're in crisis at the moment anyway. And ironically, I think the crisis we've got is probably as encouraging for energy transition as you can probably see, but for different reasons, which is energy security of supply. Most countries out there have abundance of renewable energy and will now pay up, or will be prepared to pay up significantly not to have the disruption of security of supply. And I mean, I was doing my calculations the other day, and I was going around IKEA, and I reckon I could burn a flat pack cheaper than Russian gas right now. So I'm afraid that your IKEA is empty. I've got a truckload of the stuff, and I'm all right for this winter. But that's the trade-off that you're going to see, which is you can build anything today, and it's cost-effective against the gas price. And if you believe, like I do, that we've got 5 years minimum of high energy prices, I think it's about as encouraging as you get for a rapid acceleration. And indeed, I know we had a Bundesbank bashing earlier, but one of the areas I think will come out of this Russian invasion will be a significant increase in renewable energy targets coming from European countries. So far, we've only seen Poland and the UK do it. I'm waiting for France and Germany to really up the ante, and we haven't seen it, but I think we'll see it coming. So I think we're going to get there. The flip side of it, though, and again, we have as a panel we have mentioned this, is that there's going to be awful pressure on the population, and you're sitting here kind of going, I'm prepared to pay more for climate change, sort of mitigation and adaptation. And I suspect everyone in this room is as well. But there are an awful lot of people out there who will not. And you have to get them on board. And one way that you can only get to do that is, firstly, with the reform of the power markets, that only goes so far. Power is only 20% of energy demand in Europe. You know, fossil fuel burners is still 80%. That's gone up significantly. You're going to have direct market intervention, either at the extreme nationalisation, or you're going to have significant levels of power price manipulation, or direct subsidies, or tariff deficits like you had in Spain. So I think we are in a crisis. We are going to see a material increase in energy transition. I think bills will go up and stay up. For what it's worth, I'm predicting, similar to other people, 3,400 for the average family next year. And it was 1,200 12 months ago. And the only way to get that, you've got to get everyone on board. So.
Thanks, Dominic. Can I take a question from the gentleman in the fourth row on the far left, my far left? Thanks, Jim.
Can I just say, I mean, Dominic, look, the cost of building a wind farm today is 10% of the cost of running gas, right? I mean, France is trading €1,000 a megawatt hour for December, and you think the crisis is going to run for 5 years. It's not asking voters to pay more.
I agree with you.
Right? So the future is not, this is a mischaracterization of what the transition is in cost terms. First point. Second point is, European countries are doing it. Northern Wind plus Denmark is it's 105 gigawatts that's just been committed to. TenneT just put out a tender for 50 gigawatts of subsea infrastructure. So this stuff is happening now. So this was going to be my question, right? How is, when you see European countries put down plans that ambitious, and they're huge, Denmark just added 7 gigawatts by Christmas to their targets, right? When you see that, how is this stuff going to get financed? Because I see BP paying through the roof for subsea leases, yet we're having a debate about whether the cost of capital for renewables really works. I don't really understand what I'm missing about the whole complex, the levelized cost, the ambition, the energy security questions, the cost of capital. How is this going to get financed?
I'm aware that I've talked a little bit, so I'll just quickly run through my things. First of all, it's from where your starting position is on the cost of it. Building offshore wind and solar today is clearly cheaper than all alternatives, okay? And you're absolutely right, and that's one reason why the market will get to that conclusion, and we're going to see massive pickup. But I will say one thing, the elephant in the room is heating. If you look at the actual cost and the actual carbon emissions that come out there, electricity is not, it's the easiest to decarbonise, which is why it's been the focus. It's not the biggest. The cost is going to be when you decarbonise heating. That's going to be the real expensive one. So I can't see how, to the general consumer, decarbonising heating is going to be cheap. I mean, hydrogen's it's got a role, really expensive. I know people we can get cheap power, but then you're subsidising it from one hand to the other. But Tick, I agree with you, right? It should be pretty good. The adage that we always have, and it might be questioned, so I'd be interested to hear what the other people on the panel is that generally the world is awash with money. There is no shortage of money out there. There's more money than there are bright ideas, and there are more bright ideas than there are actually people. And actually that's one of the issues that you're going to face, by the way, on getting your expansion. Hinkley Point C is short of 1,000 employees. Sizewell C, I don't even know how the hell they're going to fight to get the employees to work on that one. If you want your offshore wind to double or triple, which it needs to, where do you get the employees from? But the money is not actually, in my view, the issue. It might become an issue if we end up tipping into a recession and end up with high inflation, in which case it will be rationed. But the cost of capital won't be then 4.5%, which is what I use for offshore wind today. It might be 7 or 8 or 12 or 15. It will still get built, but it will just be on whatever the numbers are. I don't know if anyone else has got.
I tend to share Dominic's concerns, really. I mean, our view on this is that, for example, the EU's Green Deal is highly inflationary in the short term, and that top taxpayers will fit the bill for that. And our concern is similar to yours, which is that ultimately what is the willingness to pay of the voter for this? in the near term for a longer term benefit. Because if votes start to err away from green, let's say, either green parties directly or indirectly, the influence that that has on other parties, it really removes the mandate for some of this. So there is definitely a worst case scenario where essentially, you know, it comes down to people. And, you know, we tend to agree with the 5-year time horizon of a higher than average power price. And that's gonna really hit the consumer, for sure.
Jim, can we take a question from the lady in the front row, please?
Hello, thank you everyone. My name is Thiri Damwan, I'm from Morgan Stanley. I just wanted to zoom out a little bit. We've spent a lot of time on energy, as an asset class, and also financing it maybe at the project level and at the issuer level. I wanted to take from the title of this panel, which was risk pricing across sectors and asset classes, and wondered if the panel has a view on whether sustainable investing, ESG-related investing, really is having meaningful change in both the fixed income and equity markets. I work in fixed income, so I'm more interested in that, but obviously want to hear both, and especially on the listed space, because if you look at the wall of capital out there, it's with the asset owners, and are they able to meaningfully deploy capital given all the fiduciary responsibilities that they have?
So I think if I can start on that, Dominic mentioned something around the capital strike in terms of equities, and certain type of assets are very hard to finance right now in listed markets. So we looked at the deal, Port of Newcastle, big thermal coal port in Australia. They tried to do a bond deal last year. It just priced way much wider than where they should have based on their rating. It's very hard to access equity for that. But then we have the great asset class of private assets, which is a good way to combine fixed income and equity, lever it up, and get the opacity as well. So you can hide away some of the assets there, and we see quite a lot of stuff going on in that sense. Lease-back transactions on for pipeline infrastructure for oil companies, for example, which is a good way to get public assets into the private markets, and then SPV it and get public fixed income financing it. You also have that on the asset owner side, where without mentioning any names, some Californian pension funds, very forward-leaning when it comes to what they're doing in their public equities and public fixed income books, and then they go on their private books and invest in. There's this company Ameridev, which is like the biggest flarer in the Permian Basin. It's the biggest owners of that is actually coming through Californian pension funds, which is insane when you look at what's going on in the public side. So there's a big divide between public and private, and I think that's going to have to work out over the years, and we, investors and asset owners have to also start, poking into that private part of the whole.
Can we get a question to the gentleman in the second row, please, Jim?
Thanks very much. Tom Gosling, London Business School. Thanks for some great discussion today. We've got a situation at the moment where there's a lot of companies that are doing joint financing of fossil fuel and renewables, and we've seen in the UK, Elliott put pressure on SSE to split those out. And I'm just wondering whether the panel has any views on what's most effective for a transition, and whether there are any cost of capital implications about whether it's better to have these housed and have fossil fuels transitioning progressively, or whether it's better just to split it and have different entities doing different stuff.
Just to add here, when you look at the valuations of European utilities as a classic example, we split them into 5 subsectors. You've got waste, you have generators, pure play merchant generators. Alongside generators, you have renewables, pure play renewables. And then you have the regulated networks, and then you have the vertically integrated utilities. And they all trade on different multiples and different methodologies. But the glaring thing that comes out of this loud and clear, and has done over the last 2, 3, 4, 5 years, is that investors are prepared to pay more for specializations and for single issue companies. So if you look at where the most expensive sector lies, well, regulated utilities at the moment are really trading very high. They're very rich, but that's a market-wide recession trade. The pure play renewables are currently trading with an implied pipeline length of, I think last time I ran the numbers, about 12 years. So you're an investor, you're buying the assets, and you're buying the expectation of how much money they'll make on building 12 more years of renewables. Historically, utilities would probably price in 5 years over the 25 years I've been looking at them. Generators are the ones who are making the money from gas and coal at the moment. They're trading well as well. So everything's looking pretty good, except when you get to your vertically integrated subsector. And when you go to the vertically integrated subsector, that's your NLs, your Iberdrolas, your SSEs. They trade on huge discounts to all the other subsectors in utilities. You can buy their portfolios for nothing. And bearing in mind that NL and Iberdrola, the world's two largest renewable developers, you can buy them on seriously very good valuations. And coming back to your question, well, why is that? One is that investors don't like complexity. And secondly, the ESG money still doesn't like vertically integrated utilities that have a fossil legacy, even if they themselves are saying that they will be transitioning. That story still doesn't wash. And Elliott obviously had a go at SSC to split for that reason, but they're not going to.
Yeah, I would agree with that, and NL's probably one of the victims of that, and just a few examples of that sort of specialty sort of business models that have been successful. There's Aker BP, Aker Solutions, Aker Carbon Capture, particularly the carbon capture listed equity went gangbusters when it came to market. And when you speak to them, you know, they're very candid in that, well, if it doesn't work, we'll just bring it back in and then we'll spin it off as though it's the easiest thing in the world. So I think a lot of companies are looking at this and will test the market, and then if it doesn't work, but yeah, I think Aker Carbon Capture, the share price is still looking pretty good.
There are some fantastic horror stories, right, with you know, companies destroying shareholder value on the back of trying to be integrated. I mean, think the Fortum Uniper story, for example. I mean, Fortum to actually branch out into sort of Russian gas and coal, that wasn't a great idea. Add to that, then buying French nuclear reactors, that was, you know, it's not great. The Swedish utility company Vattenfall then went on a big binge of buying, you know, German lignite assets in the early noughties. That was a pure destruction of taxpayer money, like we've never seen before. So from a shareholder value perspective, it doesn't seem like it's a great idea. The question is, what's the climate impact? Should we sort of retain these assets and let these companies, you know, pay them down? Is that the right solution, or should we isolate them and sort of get them into paint fossil assets into a corner? And that's a much harder question. I think the evidence is still, you know, debatable on what's the best solution there.
We're running out of time, so just a couple more questions. This lady on the edge of the row here. Thanks, Jim.
I would just like to request that Ulf emphasize and elaborate on an earlier point about engaging in equities, denying debt. Very important point.
So yeah, I mean, I think, you know, the engagement opportunities in fixed income are massive because you have this sort of constant new flow of capital, right? It's you're rolling your debt, you're supplying new capital, you're giving out new loans as an investor the whole time. So the engagement opportunities are quite more substantial in fixed income than we traditionally think about it as a passive asset class. So that's a very, very important part. However, having said that, when you're sort of denying debt, you're shifting the supply of capital, you're actually changing the price of capital that has this sort of cash flow impact. And that's different in fixed income relative to in equities, where, you know, if we buy and sell Exxon share, it doesn't really matter for Exxon. However, if, you know, I decide myself not to lend money directly to Exxon, to not buy their bonds, that shifts up their cost of debt by 1 basis point, well, then that's actually an effect that sort of goes into their investment decision functions.
Last question, the lady by the window over here. Thanks, Jim.
Hi there. Hello. Tessa Walsh from IFR. I'd just like to ask the panel, and possibly some investors, why should investors, bond investors specifically, not accept two-way pricing? Banks already do that on the sustainability-linked loan side. So I'm curious, I think the concept's under discussion at the moment, and I'm very interested to hear a bit more about that. Thank you. And a great panel discussion, by the way. Thanks.
I'm sure I sort of missed the question, the core part there.
Why should bond investors not accept two-way pricing on sustainability-linked instruments?
Why they shouldn't accept two-way pricing? Yes. I mean,
should that be introduced?
So you're thinking that investors should be market makers, or I'm not sure I understand the concept here.
The sustainability-linked format with step-ups and step-downs for bond investors is under discussion for a sovereign, at least at the moment, and potentially other issuers as well. And why should that structure not be implemented in the bond market if banks already are doing it in the loan market?
No, it is being implemented in the bond market, right? I mean, the SLB market grew by something like 130 billion last year, which is pretty massive, and it's growing at least by the same this year again. And I think it will soon overtake the green bond market in a couple of years, so then we're talking into the trillions. So that's definitely happening in the bond market. We have a great paper about that, so I'll give it to you.
Well, thank you so much for all being so generous with your time and thoughts. If we could give the panel a round of applause. Thank you.